I can call you Kivanim if you want. Whichever one you want. Kivanim means woman. But at my age, all of you guys are girls. Gals, I'm sorry. But if there are some guys who want to be recognized as girls, that's their business. I use the age-old Seinfeld statement. Not that there's anything wrong with that. All right. Somebody else tell me if they know what statement of cash flows does. What's the purpose of that? Again, it's something you won't see that often, but we're not going to use it that often either, but there are certain things that we're going to grab from there.
Shows like where the money's going and where it's being used for.
In principle, you are correct. What it does, it takes two consecutive periods or during a period, it looks at how much your cash has changed, okay? Let's say your cash increased by $100 million. It decomposes into three components. Cash from operations, and cash from investment activities, and cash from finances, okay? As finance people, we don't consider statement of cash flows a useful way to look at cash flows, but there are certain things we're gonna figure out from there. One of them, if I wanna know what the depreciation is, it's almost always in the statement of cash flows. If I want to know how much new equity was raised, it's there. How much new debt was raised, it's there. And there are also certain things that I want to see. For example, I'm going to download a published financial statement for a company and we'll go over it, but certain companies charge the value of stock options they have into research and development. So if you look into income statement, there's a big chunk on R&D. And that's because they don't know where to put it. And technically speaking, you give options to your employees so that they could develop stuff.
And sure, it's just a bunch of legal bureaucracy and it would cover you for expenses because if you put it somewhere else, you could be like,
Right. But in the statement of cash flows, there is actually an item called stock-based compensation. Okay? And I'm gonna go over how that works. And those could be rather significant. I don't know if you guys heard 2 years ago, Elon Musk was selling a lot of Tesla shares. This was before they had split the stock. The shares were trading around $1,000, and he was selling about $10 billion worth of stock. And the company was worth around $1 trillion those days. And some people said, oh, he doesn't believe in his company. No, that wasn't the case at all. Since he has been the CEO pretty much from the get-go, he had a lot of employee stock options. Typically, these employee stock options are granted at the money, which means if the shares are trading at $50 now, they give you a right to buy those shares at $50 sometime over the next 10 years. There's typically a vesting period. You can't do anything about it the first 3 years. But after that, anytime you want, you can bring $50. Company is obligated to give you one share. If the stock is trading at $1,000, that's a pretty good deal, right? And at the end of 10 years, or the employee leaves the company, those options become worthless, okay? He had options from 10 years ago that were about to expire. And the exercise price on those was either $15 or $20, but the stock was trading at $1,000. If he didn't use them, he would have basically given up a lot of money. But as soon as you exercise that option, IRS says, okay, you had 1 million, let's call it 10 million options. You bought them at $20. and the market value for that is 1,000, right? And whether or not you realize that, IRS doesn't care. IRS says you made $980 per share at what you want to call 10 billion options. That's equal to $9.8 billion, and I'm going to charge you tax on that. You know, given Elon Musk's tax bracket, including the state and other stuff, you probably will have to pay about half as taxes. But this guy doesn't have cash. Most of his wealth is in either SpaceX or Tesla stock. So he needs to raise cash. He didn't even want to sell. He didn't even want to sell those, but he had to sell enough shares so that he could pay for the tax. If you accountants like attaching expenses to their purpose. Technically speaking, even though he's CEO, you can view that as a R&D expense. But that expense is not a cash expense either. You didn't have to do this until 2006. You know, if you're an accounting major, you may have heard about this. There's a little circular called FASB 123R. FASB is short for Financial Accounting Standard Board. It basically says, at the time you grant an option, you have to assign a value to that using some relatively well-accepted method. And you have to amortize that over the vesting period. So if I gave an employee an option that I think is worth $3 million, and the vesting period is 3 years, every year I have to write off $1 million as essentially stock-based compensation expense, even though I didn't pay any cash. For certain analyses, especially when you're calculating stuff like EBITDA, you probably should take that out as well. But we'll get there. I talk more about that in the upper level finance classes. All right, where do we get these financial statements? You're probably thinking, oh, okay, I can get it from financeyahoo.com. Yes, you can. But it's a lot more detailed and more accurate to actually go to the actual source. Companies that are publicly traded are required to file their quarterly financial statements to SEC. Okay? And SEC has a nice little web database. It's called EDGAR. If you go to sec.gov, and I have gone there a lot. And I'm in hardwired connection. This is not a wireless issue. Depending upon the zoom level, you're going to see a company filings. If it's zoomed too much, you may not even see it. See? But if you don't see it, just zoom down. Click on company filings. Whose financial statement do you guys want to know? I can pick one myself. You know, let's pick something that interests you. You guys are not interested in any stock? All right, I'm gonna pick two of my favorite stocks. I'm gonna first do NVIDIA, NVDA, its ticker code. NVIDIA used to be just a graphics chip company, especially for gaming computers and stuff. NVIDIA was the place to go. About 3 years ago, they decided that we're going to make a lot of investment into developing high-performance AI kind of chips. And that paid off big. Okay? I'm big into AI. NVIDIA is on the hardware side. I'm also into some software company or services. I'm gonna do that too, but let's get to NVIDIA first. In fact, let's do NVIDIA just for today. When we're doing financial ratios, I'm gonna actually look into multiple companies so that we can make comparisons across. There are two types of financial statements. One is called 10K. Those are the reports that are filed in the last quarter of the fiscal year. Companies do not have to have a fiscal year that ends 31st of December. They pick their own fiscal year. If it's an end of quarter other than the last one, they're called a 10Q. I mean, there's a difference between them. At 10K, they report the income statement on a 12-month basis. And at 10Qs, they report on a 3-month basis. And I think also year-to-date basis, kind of. So say view all 10Ks and 10Qs. In this case, they haven't done their 10K yet. So I'm gonna look last year's 10K, okay? I'm gonna click on that. If I say open document, it actually opens that document. Instead, I'm gonna go on filing and hit interactive data.